There is something happening right now that thousands of Canadian retirees are not prepared for, and it could directly affect the size of your tax refund this year. The Canada Revenue Agency has a rule built into the pension system that quietly reduces what comes back to you at tax time, and most people only find out about it after the damage is already done. My name is Joseph, and welcome to Canada Pension Guide, the channel dedicated to helping Canadian retirees understand exactly what they are entitled to and how to protect it. If you are receiving CPP, OAS, or any combination of government pension income, you need to stay with me for the next few minutes. What I am about to walk you through could mean the difference between a refund that surprises you in the best way and a bill from CRA that you were not expecting. Now, before I get into the details of how this 14.5% rule works, I want to plant something in your mind that we are going to come back to. There is a specific box on your T4A slip, and there is a lesser-known election form that many retirees either overlook or never knew existed. It relates directly to how much tax is being withheld from your pension payments every single month. What many retirees often overlook is that the default withholding rate applied to certain pension income is not always aligned with what you actually owe. And that gap, that quiet little gap between what CRA is holding and what you should have paid, is exactly where refunds shrink or disappear entirely. We are going to come back to that form and that slip in just a moment, so make sure you stay with me. Let us start with the foundation. When you receive pension income in Canada, whether that is from the Canada Pension Plan or from other registered sources, the Canada Revenue Agency requires that a portion of each payment be withheld for tax purposes. This is not unusual. It is the same basic principle as an employer deducting income tax from an employee's paycheck. The challenge is that pension income exists in a different category than employment income, and the rules governing how much gets withheld are different and often misunderstood. Here is where the 14.5% figure comes in. For many types of pension income, particularly payments from registered pension plans or certain annuities reported on a T4A slip, the default withholding rate applied by the payer can sit in or around the 14.5% range depending on the payment amount and the province of residence. This rate is determined not by your actual marginal tax rate, but by a federal withholding schedule. And here is the critical point. If your total income for the year, once you add up CPP, OAS, any private pension, any RRSP withdrawals, investment income, or part-time work, pushes you into a higher tax bracket than the default withholding rate assumed, you will owe the difference at tax time. That means a smaller refund, or in some cases, a balance owing. Now on the other side of this, and this is equally important, if the withholding rate applied to your pension is actually higher than your real tax rate for the year, you may be eligible for a refund, but only if you have structured your year correctly, reported everything accurately, and taken advantage of the credits and deductions available to you. Things like the age amount, the pension income amount, the basic personal amount, and in some cases the guaranteed income supplement, which is non-taxable and must be handled carefully. These are the tools that can work in your favor, but they only work if you know they exist and you apply them. Let us talk about OAS for a moment, because there is a layer here that adds complexity. Old age security payments are taxable income. That is straightforward. But OAS is also subject to the recovery tax, sometimes called the clawback, if your net income exceeds a certain threshold. For 2024, that threshold sits at $90,997. If your income goes beyond that point, CRA begins recovering a portion of your OAS at a rate of 15 cents for every dollar above the limit. This is a separate calculation from the standard withholding we discussed, but it compounds the issue. You may be having the right amount withheld on your pension, but if OAS clawback was not factored into your planning, your refund can still shrink significantly, or you may find yourself facing a repayment. The Guaranteed Income Supplement is a different situation entirely. GIS is income tested and non-taxable. If you are receiving GIS, it does not add to your tax burden, but your other income does affect your eligibility. If your income rises above a certain level during the year and it is not reported correctly or on time, you may see your GIS reduced or interrupted the following payment period. This is why accuracy at tax time is not just about your refund. It directly affects the benefits you receive in the months that follow. Now I want to pause here and invite you into the conversation because your experience matters to this community. I would like to hear from you. Which province are you filing from this year, and has the rising cost of living affected how far your pension income actually goes? Drop your province and your thoughts in the comments below. Something like Ontario, and yes, groceries are taking a big bite. Or BC, managing, but it is tight. These comments help other retirees in the community feel less alone, and they help me understand what topics to cover next. So please take 5 seconds and leave that comment now. Something that many retirees do not realize is that you have the ability to request an adjustment to the amount of tax being withheld from your pension payments. This is done through a request to your pension payer or through the proper CRA channels. If you believe the default withholding rate is too high or too low relative to your actual expected tax for the year, you may be eligible to have that rate adjusted. This kind of proactive planning is exactly what separates retirees who are surprised at tax time from those who already know what to expect. Your T4A slip is the document that tells the full story. Box 016 on the T4A covers pension or superannuation. Box 022 shows the income tax deducted. When you sit down to review your return, or when you work with a tax preparer, these boxes need to be checked carefully against your actual situation. If box 022 is lower than what your marginal tax rate would suggest you owe, that shortfall will appear as a balance owing. If it is higher, that surplus may come back to you as a refund, subject to how the rest of your return is calculated. Let us bring this to a practical close with 3 clear steps you can take right now. First, log in to My Service Canada account and review your payment history and current benefit amounts for both CPP and OAS. Confirm that the income being issued matches what you are expecting and flag any discrepancies immediately. Second, locate your T4A slip for the most recent tax year and check box 016 and box 022 carefully. Compare the tax withheld in box 022 to your estimated marginal tax rate. If there is a significant gap in either direction, note it before you file and discuss it with a tax professional if needed. You may be eligible to make adjustments. Third, confirm that your direct deposit information is current with both CRA and Service Canada. If a refund is coming to you, or if any benefit adjustments result in back payments, you want that money arriving without delay and without a mailed check getting lost in the process. These 3 steps do not require any special expertise. They require only that you take a few minutes, log in, look closely, and act on what you see. Here is what I want you to take away from today. The tax system in Canada was not designed with simplicity in mind. It was built layer by layer over decades, and for retirees managing multiple income sources, those layers can feel overwhelming. But you are not alone in navigating this. The 14.5% withholding rule, the OAS clawback threshold, the T4A boxes, none of these are designed to trick you. They are just details that most people never had the chance to learn. And now you have. You came to this channel today because you take your financial security seriously. That matters. That is the kind of attention that protects your income, your refund, and your peace of mind in retirement. If this video gave you something useful, please subscribe to Canada Pension Guide so you do not miss what is coming next. Every week we break down the rules that affect Canadian retirees in plain, honest language. No jargon, no panic, just the information you need to feel confident about where you stand. Joseph will be right here, and so will this community. We will see you in the next one.